Gasoline prices, grocery bills, and energy bills across the United States have just surged at their fastest clip since May 2023, as the raw physical shock of the conflict involving Iran tears through the consumer economy. The consumer price index has broken past expectations, landing at a harsh 3.8%, marking the highest and most aggressive acceleration of cost increases since the systemic inflation shocks experienced 3 years ago. According to the Bureau of Labor Statistics, nearly half of this entire macroeconomic distortion is being driven by a violent spike in energy inputs, with housing expenses and basic food supplies compounding the damage. The national average for a gallon of unleaded fuel has ripped upward to $4.50, a level unseen since the supply chain crises of July 2022. Yet, if you look at Wall Street right now, the initial reaction to this structural breaking point has been incredibly quiet, almost sleepy. The S&P 500 dipped by just 0.6%, and the Dow Jones Industrial Average slipped a mere 0.7%. Financial commentators are treating this as a routine bad day on the trading floor, entirely blind to the reality that the physical nervous system of international commerce has just been fundamentally altered. This chilling disconnect between the real economy and the financial markets is a classic manifestation of the psychological pattern that legendary investor George Soros recognized to build his multi-billion-dollar fortune. Soros fundamentally rejected the mainstream economic dogma, which claims that financial markets are highly efficient mechanisms that accurately value assets and risks at all times. His core thesis was built on a simple observation of human nature. Financial markets react far too slowly to a structural disruption initially, remaining in a state of profound denial, only to catastrophically overreact later when reality finally breaks down the door. In the opening phase of a true systemic crisis, paper traders look only at nominal prices and spreadsheets, convincing themselves that a crisis is just a minor, short-term fluctuation. Because of this collective naivety, you can observe assets, commodities, and corporate equities being traded at incredibly cheap valuations relative to the actual danger ahead. It is only when the physical shortages finally manifest on the factory floors and supermarket shelves that the market suddenly panics, over-adjusting into a massive downward spiral. We are currently living through that exact underreaction phase. The collective consciousness has not yet grasped the sheer gravity of what a compromised maritime lane means for a highly leveraged global network, and this collective sleepwalking will continue until the structural scarcity forces a massive psychological break across the globe. There's a deeply embedded, almost superstitious belief in modern society that the stock market possesses a quasi-prophetic ability to forecast the future. Recently, during an analytical forum discussing the macroeconomic consequences of the maritime logistics crisis on international equities, a panel of prominent market strategists spent hours debating price charts, interest rate swaps, and options volatility. Throughout the entire discussion, absolutely none of them looked at the physical production realities of a shut trade route. They all treated the issue as if oil was simply getting slightly more expensive on a screen, maintaining the bizarre assumption that as long as you pay the higher price, the physical supply will always be there in whatever quantity you desire. But that is an absolute illusion. Supply is not merely getting more expensive. The physical volume required to sustain current industrial output is physically vanishing from the system. Right now, the equity valuations of American corporations sit at historic highs, propped up by financial engineering. However, when these companies suddenly find themselves unable to deliver physical goods because their logistics networks lack the fuel, or because everyday citizens are forced to divert every single dollar of their dwindling paychecks just to cover basic groceries and gas, those inflated market caps will utterly collapse. The conventional narrative states that a financial market crash is a self-contained event born inside Wall Street that subsequently spills over to hurt the real economy. What we are witnessing today is the exact reverse. The physical, real economy is in a state of structural jeopardy. And the paper markets are underreacting because they are staffed by people who have never run a manufacturing line, never managed an energy grid, and do not understand how physical production actually functions. If this exposure of the gap between paper market illusions and real world industrial physics has whetted your appetite to develop a genuinely realistic approach to macroeconomics, then you need to break free from conventional dogmas. By looking at systemic infrastructure through the lens of physical flows rather than abstract currency valuations, you can join a community of independent thinkers who trace exactly how capital and energy interact. There are specific structural frameworks available this week that map these exact vulnerabilities in real time, providing deep dive material that explains why standard models consistently fail to predict these breaking points. By shifting your focus toward a realistic framework of production logistics, you can begin to ask the right questions before the rest of the market enters its inevitable overreaction phase. The current geopolitical shock is poised to deliver a brutal awakening to a financial elite that believes everything can be solved by twisting a digital price dial or adjusting an asset allocation model. The harsh reality of physics dictates that it does not matter how much fiat currency you are willing to spend. You cannot run a high-velocity supply chain, heat a suburban community, or sustain advanced agricultural systems if the underlying physical volume of energy drops by 20 or 30%. This is the ultimate wake-up call for the Western economic model. Decades ago, the visionary thinker Carl Sagan warned that modern industrial societies had built a terrifying vulnerability. We have engineered a civilization entirely dependent on incredibly complex, highly integrated mechanical, chemical, and electronic processes. Yet the vast majority of the population, including the political class, making the decisions, has absolutely no understanding of how these systems actually operate. Because ordinary citizens and policymakers are so profoundly insulated from the raw production networks that keep them alive, they are entirely unprepared to interpret what happens when a critical industrial input is suddenly cut off. They view economic data through the trivial lens of consumer convenience, completely unaware of the invisible foundations that hold up their entire standard of living. Consider the sudden, unhedged explosion in jet fuel costs, which has already forced American air carriers to immediately pass on a staggering 20.7% surge in airfares directly to their customers in a single month. To the average observer, this is merely an annoying inconvenience that makes a summer vacation or a business trip more expensive. That perspective represents a complete failure to understand the architecture of modern capitalism. High-velocity air transit is not a luxury service for tourists. It is the physical nervous system of global high-value manufacturing and just-in-time logistics. Advanced microcomponents, specialized medical gear, electronic subassemblies, and critical engineering tools do not sit on slow cargo ships for weeks. They move through the sky. When jet fuel costs spike violently and airlines are forced to abandon cost hedging structures, it isn't just vacationers who get grounded, it is the rapid delivery supply chain of international technology and engineering that gets choked. Once the existing pipeline buffers of these high-value components run dry in regional warehouses, the factories dependent on them will simply grind to a halt, regardless of how much money sits in their corporate bank accounts. The exact same delusion applies to the way society views the management of the central bank. The entire financial press is currently obsessed with the political drama surrounding Kevin Warsh taking over the Federal Reserve from Jerome Powell, debating whether this transition, heavily pushed by Donald Trump, will result in interest rate cuts or if potential rate hikes will remain firmly on the table. This entire conversation is a psychological farce. We have collectively constructed a mythical narrative where we believe a handful of economists sitting in a boardroom in Washington, D.C., can tame structural inflation by tweaking an abstract interest rate by 25 basis points. A central banker can print trillions of digital dollars, but they cannot print a single physical barrel of crude oil. They cannot clear a blockaded shipping lane by adjusting a benchmark yield, nor can they use monetary policy to conjure cheap petroleum out of thin air, to drag gas back down from $4.50 a gallon. The incoming central bank leadership is stepping into a landscape with virtually zero room for maneuver, forced into a conservative corner because no amount of financial manipulation can override the raw reality of escalating physical resource costs. Yet, the political establishment responds to the systemic emergency with a level of dismissive narcissism that borders on historical comedy. Donald Trump steps before the press and describes this aggressive inflationary surge as merely a short-term anomaly, declaring that the American public will simply have to accept it as a necessary price to pay for a regional geopolitical campaign to prevent foreign weapon development. He attempts to deflect blame by pointing out that the current 3.8% rate is still significantly lower than the historical 9.1% peak experienced during Joe Biden's administration in June 2022. This is the classic behavior of an insulated political class that selects for narcissistic individuals who have never spent a single day operating a physical production network, yet possess the unearned arrogance to make sweeping decisions over a highly fragile global engine. For the first time in 3 years, the average American's paycheck growth, sitting at 3.6%, has officially fallen behind the 3.8% rate of inflation. This means that despite any nominal raises, the real purchasing power of the population is actively shrinking. With critical midterm elections rapidly approaching, this widening gap between static wages and soaring weekly grocery bills is poised to act as political kryptonite for the governing party. The elites have spent years treating the economy like an ideological playground, completely oblivious to the fact that by escalating a kinetic conflict in the planet's most sensitive energy bottleneck, they have effectively shot both of their own feet. This specific economic crisis will likely be remembered by future generations as a far more devastating historical turning point than the supply shocks of the early 2020s. While previous disruptions caused immense friction, they were ultimately cyclical bottlenecks within a functional global framework that could eventually be repaired and rebuilt. What we are experiencing today is a structural amputation of the globalized industrial architecture itself. The political decision to escalate a conflict and force the closure of a foundational trade lane was done with zero awareness of the permanent systemic degradation it would inflict on the rest of the planet. This is the catastrophic consequence of allowing uninformed, self-absorbed figures to dictate terms to a complex, tightly wound physical machine. The upcoming economic fallout will be so severe, so unyielding for everyday citizens trying to survive under the weight of negative real wage growth and escalating costs, that the structural failure of our current political selection process will become impossible to ignore. We have built an international system where critical decisions are left in the hands of naive bureaucrats and career politicians who do not understand how physical capitalism actually operates, and we will continue to pay a compounding, brutal price until the management of our societal infrastructure is guided by actual operational knowledge rather than paper illusions.